Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at FIGR Technology Solutions.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis of FIGR Technology Solutions, or FIGR. This is a really fascinating story right now.
It really is. We're basically watching a company in real time execute this pivot from just a tech platform to a financially disciplined enterprise solution.
The numbers are absolutely backing that up. You just have to look at their first quarter 2025 performance.
It's not just growth, right? It's the kind of growth that feels like it's accelerating and it's high quality.
Exactly. The core narrative here is this accelerating demand for their AI-driven workforce platform. And it's primarily targeting that enterprise segment. So you're thinking, major retailers, large hospital systems, that kind of thing.
And the Q1 numbers?
Q1 2025 revenue was $48.7 million. That's a year-over-year jump of 34.2%.
And 34.2%? I mean, that's impressive for a company this size. But like you said, the quality of that revenue is where the real story is.
It is. The leverage is in their subscription base. Enterprise subscription revenue, that alone grew 41.5% year over year.
That's the recurring stuff.
That's the sticky, recurring, high-margin revenue. It now makes up 68% of their total revenue. A year ago, it was 61%. That's a huge structural shift.
Okay, so that brings us to a really interesting strategic move. Their professional services revenue, the money from one-off implementations, that actually dropped 12%. Normally, you'd see that as a red flag. What's happening there?
It was completely intentional. This is management being disciplined. They are actively deprioritizing those lower margin services.
So they're willing to take a small hit on the top line.
They're happy to sacrifice it, yeah. If it means they can focus all their resources on the higher lifetime value, the LTV, of that recurring SaaS revenue stream, they want clients on the platform not paying for consultants.
And you can already see the payoff for that shift in the margin structure. It's pretty immediate.
Absolutely. Gross margin expanded in a big way. It's up to 72.3% in Q1.
Wow, and that's up from what?
Up from 67.1% year over year. And this isn't a one-off thing. It's structural because they're automating their own delivery workflows. It's like they're eating their own dog food to cut their own service costs.
And that leverage is carrying down the income statement, too. I mean, the operating margin is still negative, but it improved massively from a loss of negative 19.4% to, negative 8.1%.
Right, and that improvement, it shows they're getting way more efficient with every dollar they spend on R&D and on sales.
The market seems to get it. Management just raised their full year 2025 revenue guidance.
They did. The new range is now $208 to $213 million. The midpoint of that, it's up by 7.5%. That's not a small bump. That signals real internal confidence that this acceleration is going to continue.
And you see Wall Street following right along. Analysts have significantly improved their 2025 EPS estimates over the last 90 days. I think it went from negative $0.62 to negative 41 cents.
And when estimates move that sharply, price targets usually follow.
Yeah.
Which is exactly what we've been seeing.
So, okay, let's talk financial stability. That's key for a growth company that's still spending. How's the balance sheet?
It's remarkably strong. As of the end of March 2025, they were sitting on $122.4 million in cash.
And against how much debt?
That's the best part. Only $15.2 million in convertible notes, and this is crucial, zero bank debt.
So that cash gives them a pretty long runway.
A very robust runway. At their current burn rate, they've got about 2.5 years of funding. So, there are no near-term concerns about them needing to dilute shareholders to fund their growth.
Right. And this is where the story pivots from just growth to, efficiency. The free cash flow burn, FCF, that's the number everyone is watching.
And it's narrowing. In Q1, the FCF burn showed a 21.6% improvement in efficiency year over year. They're just getting much better at managing their capital.
Which leads to what I think is the most important target management has set.
You're talking about the positive FCF goal.
Exactly. They've publicly said they're targeting positive free cash flow by the fourth quarter of 2025.
And if they hit that, that fundamentally changes the entire investment profile for this company.
It does. You go from valuing it on, uncertain future growth to valuing it as a high-growth company that actually generates cash. That's a massive re-rating opportunity for the stock.
It absolutely is. But to get that future valuation, we need to understand how defensible this business actually is.
Right.
What's the competitive moat here? Why can't someone just come in and copy what they're doing?
Well, the core of it is their proprietary AI. It's a workforce optimizer they call Athena. And this is not your standard HR scheduling tool.
Not at all. Athena uses real-time behavioral analytics. So it's looking at employee patterns, customer flow, local events, even micro-weather patterns
Yeah.
to make dynamic staffing adjustments on the fly.
And it's targeted at those industries where labor is the biggest controllable cost, right? Retail, hospitality.
And healthcare. Places where optimizing labor is the difference between making a profit and losing money. Athena attacks that directly.
That dynamic element is the differentiator, but it's the switching costs that really lock clients in. I mean, they integrate the Athena API into their legacy systems, your Workday, your ADP.
Right, but the real stickiness isn't even the API. The lock-in is purely data-driven. Once a client uses Athena for a couple of years, FIGR Technology Solutions has this incredibly granular proprietary data set of labor patterns.
And that's unique to that one client's operation.
Exactly. Down to specific stores, specific employee behaviors. So if a client wanted to leave, they'd have to abandon that whole customized data set.
And starting over with a competitor would mean what? A 6 to 12-month process of retraining a new AI model from scratch.
It makes migrating almost impossible once the system's really entrenched, and that's before you even get to their IP. They hold 14 granted patents focused on this exact kind of behavioral labor prediction.
And when you stack them up against competitors, you can really see the difference. Companies like Deal or Deputy, they do HR or scheduling, but they just don't have that predictive layer.
It's the difference between looking at a schedule versus predicting what the ideal schedule should be, second by second.
And there's proof of that, right? In those blinded trials from 2024.
Compelling proof. Their algorithm outperformed competitors by a stunning 22% in labor cost reduction. When you manage thousands of employees, a 22% ROI isn't a luxury, it's a necessity. That's why they sign up.
Okay, so strong financials, strong moat. But here's where it becomes a must-watch story for me. The catalysts. That ADP partnership announced in May, that's a huge deal.
That is arguably the biggest game changer for them this year. ADP is embedding Athena directly into their Workforce Now platform. Just think about that distribution channel.
It's massive. It opens the door to over 300,000 small to mid-sized businesses, SMBs, almost overnight.
Before this deal, FIGR Technology Solutions had to hunt for every enterprise contract one by one. Now they have direct access to a huge market, and it dramatically lowers their customer acquisition cost.
And you see that confidence internally, too. The CEO just bought, 50,000 shares in May?
Yep, around $4.55 a share. It was their largest single insider purchase since the IPO. That kind of skin in the game from the top is a very powerful signal.
And it's not just the insiders. Institutional ownership has surged. It jumped from about 42% to over 58% just since Q4 of last year.
You're seeing the big names pile in, BlackRock, Fidelity. They're adding millions of shares. The smart money is clearly buying into this narrative.
So looking ahead, what are the next big things to watch?
Over the next 3 months, you have two key measurable catalysts. First is the Q2 earnings report expected around July 31st.
And consensus is looking for $55.2 million in revenue, which would keep that acceleration going. But I'd argue the FCF burn number is even more important.
I agree. Analysts are forecasting a further reduction in cash burn. If they beat on revenue, or especially on FCF, you could easily see another round of upward estimate revisions.
And catalyst number 2.
That would be the Investor Day. It's scheduled for September 10th, and that's where management is expected to really lay out their roadmap for pushing into the healthcare vertical.
Healthcare is a monster of a market. It's complex, high margin, staffing is everything. If they can show a clear path into that market, it opens up a whole new, total addressable market for investors to get excited about.
But we have to keep a balanced view here. We have to talk about the bear case. Risks do exist.
Absolutely. The number one concern for me is revenue concentration.
Yep. The top 3 clients made up 28% of Q1 revenue. That's a lot of exposure. Losing even one of those contracts would definitely cause some turbulence.
But they are actively working to mitigate that, right? The ADP partnership is a long-term fix, getting them thousands of smaller clients.
Exactly. And they added 9 new enterprise logos in Q1. So they're already reducing that reliance. You should see that concentration risk come down over the next, say, 6 to 9 months.
The second risk is what I'd call profitability timeline risk. They promised positive FCF by Q4.
And investor patience has its limits. If they miss that target, the whole thesis comes into question, and you could see a pullback based on execution concerns.
The good news there, though, is that they're reportedly tracking ahead of their burn reduction plan. And that $122 million cash cushion gives them a huge buffer. Their backs are not against the wall.
So finally, let's look at the technical picture. The stock itself has really strong momentum. It's been trading in a multi-month ascending channel, a clear upward trend.
And we just saw a big technical signal confirm in May, the Golden Cross. For anyone who doesn't follow charts, that's when the 50-day moving average crosses above the 200-day. It's a classic long-term bullish signal.
And the chart is giving a pretty clear entry area, too. It broke out above $5.20, then pulled back to $4.75, which held as really strong support.
So that confirms an accumulation zone somewhere between $4.50 and $4.90 for new buyers.
Right, and when you put that technical picture in a valuation context, it really highlights the opportunity. It's trading at roughly 3.5 times projected EV to sales.
Which is very attractive compared to its lost peers.
Yeah.
Similar growth companies are often trading at, 6 to 8 times sales, so the market is not yet fully pricing in that path to profitability.
So FIGR Technology Solutions is in the middle of this really efficient transition from just pure growth to growth plus profitability. The real test for the company, and the key thing for you to watch, isn't just revenue. It's whether they can keep that exceptional gross margin while they scale into that massive SMB market with ADP.
If they manage to do both, that 3.5x valuation is going to look like an absolute steal very, very quickly. That's our analysis for today. Make sure you hit subscribe so you don't miss our next stock analysis tomorrow.